Okay, students, let's start our practice sessions. In today's practice session, we are going to practice the MTQs, which is normally tested in the section B of our paper. And this question is normally 10-marker questions, right, in which the examiner will give you some background information, just like this. Then the examiner will ask 5 questions, and each question will carry 2 marks. So let's start our practice sessions. So the first MTQ, the following scenario relate to question 231 to 235. Speculate company owns two property and uses fair value accounting where possible. Just remember one point that speculate owns two properties and speculate company use fair value accounting. Fair value accounting. If it is IAS 16, it will be always revaluation model, and if it is IAS 40 investment property, so the model will be fair value model, right? Just remember this point. Property A, an office building used by speculate for administrative purpose. A property A, an office building used by speculate company for administrative purpose. Administrative purpose means that it is an owner occupied property. So for the owner occupied property, we will always apply IAA 16, property, plant and equipment, right? At 1st April 20x2, it had a carrying amount of $2 million and a remaining life of 20 years. I will be doing all of my working to the nearest $1,000. Just remember one point that I will be doing my all of the working to the nearest $1,000. So the carrying amount of this property is $2,000 and the remaining useful life is 20 years. On 1st October 20x2, the property was let to a third party and reclassified as an investment property. On 1st October 20x2, after the 6th month, 1st October 20x2 means after the 6th month, the property was let to a third party and reclassified it as an investment property. So there is a change of use, change in use of the property. First, the property A was classified as an owner-occupied property, so we will have to apply IAA 16 property, plant and equipment. Now on 1st October 20x2, it was reclassified as an investment property. So there is a change in use. And you remember the 3 steps in the chain where there is a change in use of a property. First, you have to apply the old applicable accounting standard, then you have to do the transfer entry, and at last, you will follow the new accounting standards. The property had a fair value of 2.3 million at 1st October 2002. At the time of change, the fair value of the property is 2.3 million and 2.34 million at 31st March 2003 at the year end. Let me explain it with the structure. The year start for this company is 1st April 20x2, right? And the year end for this company will be 31st March 20x3, right? 31st March 20x3. On 1st April 20x2, the property A was classified as an owner-occupied property. So we will have to follow the rules of IAA 16 property, plant and equipment. At this time, the carrying value of this property is 2000. It is 2 million. So 2 million in term of 1000 are 2000, right? And the remaining useful life, RUL mean the remaining useful life of this property is 20 years. Now, after the 6 months, on 1st October 20x2, the fair value of this property is 2.3 million here, 2.3 million. So 2.3 million in term of 1000 is equal to 2300, and the fair value of this property at the year end, it is 2.34 million, so it will be equal to 2340 in term of 1000. Now on 1st October 20x2, there is a change in use of the property. It has been transferred from the owner occupied property to the investment property, mean from IAS 16 to IAS 40. Now at the date of change in use here, we will follow 3 steps. The first step will be use the applicable accounting standard, means the old accounting standard. Then you must do the transfer entry. You have to transfer it from IAS 16 to IAS 40, And at last, the last step will be start the rules of new accounting standard. Now, according to our relevant steps, first we will have to apply the old applicable accounting standard. Now, the old applicable accounting standard was IAS 16 property, plant and equipment. So this property will be depreciated as per the rules of IAS 16, and we will have to charge the depreciation only for the 6 months, because after the 6 months the property has been transferred to investment property. So how we will charge the depreciation? The formula for the depreciation is cost divided by useful life multiply by 6 divided by 12. So let me use my calculator. 2000 divided by 20 multiply by 6 by 12. So the total depreciation charge will be $50, right? In term of thousand, it will be $50. Now, if I have to find the carrying value at the date of change here on 1st October 20x2, it will be cost minus accumulated depreciation. Now, what is the cost? It is 2000. And what is the accumulated depreciation? It is $50. So the carrying value be 1950. Now we have find the carrying value of the property A at the date of change in use. It is 1950. Now, if you look at to the fair value of the property at the date of change in use is 2300, and the examiner already specified that the speculate company always use the fair value accounting where possible. Now we have to follow the rules of revaluation model. In the revaluation model, we will always classify our non-current asset at revalued amount. Now the revalued amount of this property is 2300. Now there is an upward revaluation of this property by which amount? That is 3350. Now it is an upward revaluation, and upward revaluation will be classified in other comprehensive income. Any question till here? It will be classified in other comprehensive income. Now the step number 1 has been satisfied. Now we'll follow step number 2. We will have to do the transfer entry. Now we will have to transfer this property from IAS 16 to IAS 40, and it will be transferred on the revalued amount. And what will be the transfer entry? The transfer entry will be investment property debit 2300 and the property, plant and equipment credit 2300. Right? Now the rules of IAS 40 will start. No depreciation on this property, because we will be using fair value accounting, right? We will be using the fair value accounting, and any gain or loss will be classified in P&L, profit or loss, right? Now at the year end, the fair value of this property is 2340, and there is a gain of the on this property. So the gain is 2300 is the old value. The fair value at the year end is 2340, and there is a gain of $40, right? And this gain will be shown in the profit or loss, and no depreciation will be charged on this property once it is transferred to IAS 40 investment property. Now the examiner may be asked in different type of questions, right? The examiner may be asked that what would be the depreciation charge for the year. So it is $50 here. Now the examiner may be asked that what will be shown in the other comprehensive income. It will be 350. It will be shown in other comprehensive income because it is a revaluation surplus. The examiner may be asked that what will be the gain on this property, which should be shown in the profit or loss. So it is a $40, right? The examiner may be asked that what will be the net income. The examiner may be asked that what will be the net income, which should be shown in the profit or loss. The net income means that you have to offset the income and expenses. You have to offset income and expenses. Now the total income which should be shown in the profit or loss is $40, and the only expense which should be shown in the profit or loss is $50 depreciation expense. So there is a $10 of expense, right? The examiner may be asked different types of questions from this paragraph. Any question till here you may ask? Okay, so now let's move to para 2. They are talking about now property B. Property B. Another office building let on a 12-month lease to a subsidiary of Speculate. Now you guys might be thinking that what is mean by a subsidiary? Did you remember the concept of consolidation in your past or your basic study? If not, let me remind you. Let's say for example, there are two company. One is known as the A company, the other one is B company. Now, A company acquired B company in such a way. Just listen to me. There are two company. One is A company, the other was is let's say for example B company. Now the A company acquired the B company in such a way that A company gained control over the B company. Right? Let me repeat my point again. Let's say, for example, A company acquired B company in such a way that A company gained control over the B company. A company control gain over the B company. So A company will call the parent company and B company will be the subsidiary company, right? The investor company is called the parent company and the investing company is called the subsidiary company. Now it's the responsibility of the parent company that he will prepare the two financial statements. Now it's the responsibility of the parent company when he acquired the subsidiary company. It's the responsibility of the parent company that he must prepare two financial statements. One is known as individual financial statement, in which he will show the performance or the position of a single entity means its own company, and the other one will be consolidated financial statement. The other will be consolidated financial statement. Now, what is mean by the word consolidation? What is mean by the word consolidation? Consolidation means adding together. Consolidation means adding together. What do you mean by the adding together? We will have to add the financial statement of A company and B company. This process is known as consolidation. Did you get my point? Let me repeat it again. Let's say, for example, A company acquired B company in such a way that A company gained control over the B company. Now, the A company will be called the parent company because it's the investor company and it's gained the control over the another company. Now, the B company, which is an investee company, the investee company will call subsidiary company. Now, if the parent company acquired the subsidiary company, it is the responsibility of the parent company that he must prepare two financial statements. One is individual financial statement in which he will show the performance or position of its own entity. That's it. And another financial statement he must prepare that is consolidated financial statement. Consolidation means adding together. Mean he will take the financial statement of A company, the parent company, and the financial statement of B company, all of the financial statement, and he will add it together. Now the process of adding together of the financial statement is known as consolidation. It is known as consolidation. Now there is a one common rule in consolidation. In consolidation, both the parent company and the subsidiary company are always treated as a single entity. It will always treated as a single entity. The complete group is always treated as a single entity. Let me repeat my point again. In for consolidation perspective, there is a general rule, a common rule. You maybe write it on your page with yourself as well. There is a general rule for the consolidation, and the general rule is that for the consolidation, the parent company and the subsidiary company means the complete group. This the complete group. A company and B company they form a group. The complete group is always treated as a single entity. You will always assume that A company and B company are not a distinct entity. They are not the distinct company. For the consolidation purpose, you will always assume that both of the companies are a single entity. They are considered as a single entity. So for this single entity, always the intra-group transaction has been eliminated. The intra-group transaction has been eliminated. So because of this concept, if any transfer of investment property is from the parent to subsidiary company or whether from the subsidiary company to parent company, it will be always treated as an owner occupied property in consolidated financial statement. You may treat the investment property in the individual financial statement. Let's say, for example, A company rented a property to B company. A company rented a property to B company. It will be treated as an investment property in individual financial statement, but it will be always treated as an owner occupied property in the consolidated financial statement. Right? Why? Because the whole group for the consolidation perspective, it is always treated as a single entity. For the consolidation perspective, the complete group, the complete entities, the two different entities are always treated as a single entity. So according to that concept, any transfer of the investment property from A to B or from B to A, means from the parent to subsidiary or from subsidiary to parent company, will always be treated as an owner occupied property in the consolidated financial statement. They will show in as an investment property in individual financial statement, mean in the B individual financial statement, in A financial statement, it will be treated as an investment property. But from the consolidated perspective, it will be always treated as an owner occupied property, and you will apply IAA 16 in consolidated financial statement. IAA 16 in consolidated financial statement. Did you get this concept? If you have any question, you may ask now. Okay, so let's start the second paragraph again. The property B, another office building, let on a 12-month lease to a subsidiary company, means the parent company let the property to subsidiary company. Now, in the individual financial statement of the parent company, it will be treated as an investment property. But from the consolidated perspective, it will be always treated as an owner-occupied property. At 1st April 20x2 means at the start of the year, the fair value of the property is 1.5 million, which has risen to 1.6 million at 31st March 20x3. Now, if I do my working over here, at the year start mean at the 1st April 20x2, the fair value of the property is 1.5 million, and at the year end means at 31st March 20x3, the fair value of the property is 1.65 million. If I'm doing all of my working to the nearest $1,000, so let me write it in term of thousand. So it will be 1500, right? And it will be 1650. So there is a total gain which should be shown in the statement of profit or loss. In individual financial statement, a total gain of $150, right? Okay, so it was a complete background information which has been given by the examiner, and we have explained it already. Now let's solve the questions. The first question is question number 231. What is the correct treatment when property A is reclassified as an investment property? What is the correct treatment? What is the correct treatment that when we are transferring a property from IAS 16 to IAS 40, what will be the correct accounting treatment? So the option A is take the $350,000 gain to other comprehensive income. So it's the correct option. Why? Because I have already told you that when we are applying the old accounting standard, we will applying the old accounting standard. If any gain or loss arise, it will be transferred to OCI because the old accounting standard is IAS 16, and we are transferring a property from IAS 16 to IAS 40. In IAS 16, the model is revaluation model. If there is any upward revaluation or gain on revaluation, it will be always be shown in the other comprehensive income, not in the profit or loss. So it will be shown in other comprehensive income, and the total gain is $350, as I already calculated over here. $350, and it will be shown in other comprehensive income. Okay, another question. Which of the following models can speculate use to account for investment property, right? In its individual financial statement, speculate company in its individual financial statement. Which models can the speculate company use? He may use the cost model, he may use the fair value model. The revaluation model is for IAS 16 property, plant and equipment, not for the investment property. So 1 and 3, correct option is option B. Okay, now question 233. What is the total gain? Examiner is asking about the total gain. Total gain for investment property to be included in speculate individual statement of profit or loss, not in consolidated. It is in individual financial statement, right? For the year ended 31st March 20x3, enter your answer to the nearest dollar. Now, what will be my total gain? The total gain which should be shown in the profit or loss on the property B is $150. On the property A, which I have been already calculated, it is $40. If I add these two together, the total gain will be, what will be the total gain? So from property A, which should be shown in the profit or loss, it is $40. It has been already calculated over here. And from property B, it is $150. So the total gain will be 190. But you have to answer completely, right? You have to write over here 190,000 because I'm doing all my working to the nearest $1,000. But you have to answer in the answer box a complete answer, right? You don't have to skip the 3,000s. It is just only for the working. Okay. The next question, question 234. In the individual and consolidated financial statement of speculate, how would property B be accounted for? Property B will be accounted for in the consolidated and individual financial statement. So as I already explained that individual financial statement, it will be shown as an investment property, and consolidated, it will be always shown as an owner occupied property under the heading of property, plant and equipment. Now the last question, question 235. What would the carrying amount of property A be at 31st March 20x3? Speculate use the cost model for investment property. Now, at the start of the question, examiner already told us, that the speculate company used the fair value accounting. The speculate company used the fair value accounting where possible. Now the examiner changed the scenario and he is asking that what will be the carrying amount of property A at 31st March 20x3. Speculate company use the cost model. Instead of fair value model. If the speculate company use the cost model, what will be the carrying amount at the year end? Now, if you remember that for the property A, there is a change in use from IAS 16 to IAS 40. Now remember one point, as you already learned from your lecture, that the cost model for the both accounting standard, whether it is IAS 16 or whether it is IAS 40, the cost model for the both of the accounting standard are same. You have to chart the depreciation and there is no upward revaluation or an increase in the fair value of the property, right? So the cost model for both of the accounting standard are same. You have to chart the depreciation and you have always to report the investment property at carrying amount, whether you are applying the IAS 16 cost model or whether you are applying the IAS 40 cost model. There is the same rules for both accounting standard under the same model. So at the start of the year, if you look at the start of the year, the carrying amount of the property is 2 million. It is 2 million. 2 million means in term of thousand, it is 2000, right? And the remaining useful life is 20 years. So divide by 20. And what will be the depreciation for the complete year? It will be 100. And the carrying amount will be cost minus accumulated depreciation. And the carrying amount will be 1900. So it will be the value if the cost model used by the speculate company. So the answer is 1900,000, option B. Okay. Now MTQ number 2. Now this MTQ cover IAS 38 intangible asset, right? So if you want to open the notes, so please open the rules of IAS 38 intangible assets. The following scenario relates to question 241 to 245. Now these MTQs are from your Kaplan kit. Okay. Well, Rock Company has the following research project at 31st March 20x7. The year end is 31st March 20x7. Remember the year end in your financial reporting paper. Always look to date carefully. The year end is 31st March 20x7. So what will be the year start? If the year end is 31st March 20x7. Then what will be the year start for the Wilrop company? It will be 1st April 20x6. It will be 1st April 20x6. Okay. Now, the project 324. The project commenced on 1st April 20x6 mean at the start of the year. The project has been commenced at the start of the year and incurred a total cost of $15 million during the period to 31st December 20x6 on a pro rata basis. Pro rata basis means equally each month. Equally each month. Pro rata basis means equally each month. Right? Up to 31st December. Now, what will be the total number of months from April to December? April, May, June, July, August, September, October, November, December. Total of 9 months. And the total cost is 15 million. So what will be the cost per month? So 15 million divided by 9. So 15 million divided by 9. So the cost per month is 1.67, right? To the nearest $1,000, it may be 1.67. Okay. So the project commenced at the start of the year on 1st April 20x6 and end at 31st December 20x6. Okay. On 30th June 20x6, the director were confident that the project met the capitalization criteria of IAS 38 intangible asset. On 30th June 20x6 mean here on 30th June 20x6, the pirate criteria has been met. The pirate criteria has been met. Now you will start capitalization from here. Now you will have to capitalize the cost from here because the criteria has been met on 30th June 20x6. Now before this date, all of the cost incurred will be expense to profit or loss because no criteria has been met and it will be expense to profit or loss. Now what is the amount that should be expense to profit or loss? So the months are April, May and June. The total cost is 15 million. So 15 million multiplied by 3 divided by 12. 15 million multiplied by 3 divided by 12. Not 12, sorry, 9. The total time period for the project is 9 months, sorry. Divided by 9. So a cost of 5 million will be expense to profit or loss, and the rest of 10 million will be capitalized as an intangible asset, right? Because the capitalization criteria has been met on 30th June 20x6. The total cost is 15 million, in which 5 million will be expense to profit or loss, and the rest of 10 million will be capitalized as an intangible asset. Now the project was completed and began to generate revenue from 1st January 20x7. When the project has been completed on 31st December 20x6, it is immediately available for use. So when it is immediately available for use, so you will charge amortization from here. Okay, so you will charge the amortization expense from the date when it is available for use because of the matching concept. It is estimated that the project will generate revenue for the 5 years. The total useful life for this project is 5 years. So the total cost that should be capitalized is 10 million. Now how you will find the amortization expense? So for amortization expense, the formula is cost divided by useful life, 10 million divided by 5 multiplied by January, February and March. So we will charge the amortization expense for the 3 months. So it will be 10 divided by 5 multiplied by 3 divided by 12. So amortization expense of 0.5 million will be charged for the year ended 31st March 20x7 for the project 324. Now let's move to another project, that is project 325. The project commenced on 1st September 20x6. Cost of 20,000 per month were incurred until 31st January 20x7 when the project was abandoned. The project is abandoned. The project is abandoned. I am repeating my point again. The project is abandoned. So if the project is abandoned, so all of the cost incurred will be expense to profit or loss. All of the cost incurred will be expense to profit or loss. Now, what will be the total cost? It is 20,000 per month. So 20,000. Now, what will be the total number of months? It starts from 1st September till 31st January. So September, October, November, December, January, a total of 5 months. So 20,000 multiplied by 5, a total of 100,000 cost will be incurred and it will be expense to profit or loss. Why? Because the project was abandoned. The specialist equipment that had been purchased for Project 325 was transferred for use in another of Wilrop research project. Okay. So there is no any other working for this project. Now let's move to project 326. The project commenced on 1st January 20x7. Cost of 40,000 per month were incurred until 31st August 20x7, when the director increased the spend to 60,000 to complete the project quickly as a potential buyer had been identified on 20th July 20x7. The director had not been confident of the success of the project until this point. The director is not confident, so no criteria met. Any of the cost incurred until 31st March 2007 will be expense to profit or loss because no criteria has been met, so no cost will be capitalized. Now it was all about the complete background information of the Wilrop Company 3 project, Project 324, Project 325, and Project 326. Now let's solve the questions. Question number 241. Which two of the following are required by IAS 38 intangible asset in relation to the amortization of intangible asset excluding goodwill? So we will have to find the statement for the amortization of intangible asset, and we will have to find the two statements. A, intangible asset should be amortized over the expected useful life or not at all if the useful life is deemed to be indefinite. So it is correct. If the useful life of the intangible asset is a finite life, so you will have to amortize that intangible asset over the life of that asset. Now, if the life of the intangible asset is indefinite, so you will not charge any amortization expense and you have to do the annual impairment testing of that intangible asset, right? So this statement is correct. Intangible assets should not be amortized. It should not be amortized, but instead review for impairment losses only. No, if the intangible asset life is a finite life, then you will have to charge the amortization expense. So it is wrong. Intangible asset should be amortized on the basis of the expected pattern of the consumption of the expected future economic benefit. So it is a correct definition of the amortization because of the matching principle. Intangible assets should not be amortized or impaired and instead simply carry forward at their original cost until sold or scrapped. No. If the life is finite, you have to charge amortization expense. If indefinite life, then you have to perform annual impairment testing. So the correct option is option A and C. Now, next, 242. Which two of the following statements are true? Two of the following statements are true in relation to IAS 38 intangible assets. Option A, IAS 38 required the revaluation of intangible assets where an entity has chosen to revalue its tangible non-current asset. Now you guys answer me whether this statement is correct or not, whether it is true or false. You guys must answer me in the chat box, please. Hurry up. Whether it is true or false. Okay, Alphami, false, false. Yes, it is false. It is false. Why? Let me explain the point. 1 minute, Winston. Okay, good. That's good. It is false. Now let me explain this option. Look, revaluation model state that if you want to revalue an item of non-current asset, then item of the same class, means you have to complete class will be kept on the revaluation model. Now, the examiner here is talking about intangible asset and tangible assets. Now, these two are not the same class. These two are the different non-current asset. Intangible asset is something else, and tangible asset is something else. Now, if you want to keep the property on revaluation model, then all the properties will be on the revaluation model. Now, it doesn't mean that if you want to keep the property on revaluation model because the property is tangible non-current asset, and now you have to some let's say for example software, or you maybe say trademark, and then you it is compulsory for you that you will keep that intangible non-current asset on the revaluation model. No, item of the same class. It doesn't state that all the non-current asset. The revaluation model state that item of the same class will be kept on the same model. Means whether it is cost model or it is revaluation model. So it is wrong. Option B, IAS 38 does not permit the revaluation of any tangible asset in any circumstances. It is wrong. You can revalue your intangible asset if there is in any active market. Active market means that where frequent selling or buying of that intangible asset occur. IAS 38 permits the revaluation of intangible assets only if there is an active market for such asset. Yes, if there is an active market, then you can find the fair value of an intangible asset, then you can revalue it. IAS 38 required that the initial recognition of an intangible must be at cost. Yes, initially any of the non-current asset will be recognized at cost. So option C and D are the correct options. Next, question 243. In accordance with IAS 38 intangible assets, what is charged to the statement of profit or loss for the year ended 31st March 2007 in respect of the project 324? The charge mean expense. The word charge mean expense, right? So in accordance with IAS 38 intangible asset, we will have to find the total expense in respect of the project 324. The total expense in respect of the project 324. So here the project 324 and the total working of that project is here, and we will have to find the total expense of this project, the total expense, and there is only two expenses. One is the research expense, which if I already told you that it will be expense to profit or loss because no criteria has been met for these 3 months. So one expense is 5 million and the other expense is amortization expense, which is 0.5 million. So 5 million plus 0.5 million, the total amortization expense will be 5.5 million. So correct option is option A, 5.5 million. Next, 244. In accordance with IAS 38 intangible asset, which of the following is or true or false in respect of the accounting treatment of project 325 and project 326? The cost of project 325 should be expense in the statement of profit or loss for the year ended 31st March 2007. So it is true because I already told you that project 325 has been abandoned and any of the cost incurred will be expense to profit or loss. So it's a correct statement. Next, the specialist equipment which was purchased for project 325 should not be depreciated, should not be depreciated. No, it will be depreciated when it is used in any of the project. It should be depreciated because it is available for use. When any of the non-current asset is available for use, it should be depreciated, right? So this statement is false. The cost for project 326 should be included as an asset in the statement of financial position at 31st March 2007. It is wrong. Why? Because the directors are not confident. The directors are not confident. If the directors are not confident, no criteria has been met, then all of the cost incurred till this date will be expense to profit or loss. So this statement is wrong. Now the last one. Which of the above cost would be capitalized as an intangible asset in accordance with IAS 38 intangible assets? During the year ended 31st March 2008, Wellrope Company incurred the following cost: 400,000 in staff cost incurred in updating a computerized record of potential customer. So it is an internally generated customer list. It cannot be capitalized. It is an internally generated a customer list, so it will not be capitalized. 800,000 for the purchase of a domain name for the website for an entity making substantial online sale. So it is a purchased intangible asset. It will be capitalized as an intangible asset. 4 million for a patent purchased intangible asset to improve the production process with an expected useful life of 3 years. So it will be amortized over the life of the asset and it will be capitalized. So the correct option is option C for this MCQ.